We've asked many guests over the past 10 days the Trump put option, which is stepping back from tariffs, the Fed put option, that you need both of these to be executed. So let's assume the paradigm shift is that we get both of these in July. What is the single biggest upside trade that I want exposure to if the Trump put is executed and the Fed put, preventative put, is executed?
So yeah, this should help the market to look beyond 2019 earnings, because they will be disappointing anyway. So the market will start to look at 2020. But I think what is more interesting in terms of, let's say, asset allocation or investment opportunities is that if we do see these two key things happening, maybe the best trade is outside the US. Emerging markets, for instance, might take advantage of a weaker dollar, Fed easing, and some good news on the trade war. So this is also something that needs to be traded. So US versus the rest of the world.
That said, Charles-Henri, you're keeping a modest overweight to US equities. Talk us through that.
Yes, no, the first, let's say the first trade is equities versus bonds. We believe that bond markets is panicking, and we don't buy this panic at this stage, and this is why, we still favor equities over bonds. That being said, we don't expect huge gain, we expect moderate gains, we also expect some volatility, but definitely the fact that we are moved from hawkish stance to a dovish stance in the Fed is helping the stock market. If you look at history, usually when there is rate cuts, the equity markets rally. Don't forget also that when you have lower bond yields, this helps share buyback. So we expect more share buyback on the US. So yes, a moderate overweight on US equities is something we recommend to our clients. And in terms of using long-term US Treasuries, we believe that this trade at this stage is a risky one, and if you want to hedge portfolio, we will prefer to use cash, which is the inversion of the yield curve, providing you with the same yields without duration risk.